our knowledge series on corporate tax in UAE. In this video, you will learn about the partnerships and family foundations. This video covers the following important matters: unincorporated partnership and its treatment as a taxable person, foreign partnerships, family foundations and its treatment as unincorporated partnership. Introduction. Corporate tax law defines unincorporated partnership as a relationship established by contract between two persons or more, such as a partnership or trust or any other similar association of persons, in accordance with the applicable legislation of the state. Note, however, that the contract between partners does not need to be a formal document. It is possible for a partnership to come into existence by verbal agreement, without anything being recorded in writing. Under Article 16 Clause 1 of the Corporate Tax Law, partners in an unincorporated partnership are not legally separate from the business. Therefore, corporate tax is imposed not on the partnership but on the individual partners, who will be liable on their allocated share of the profit of the partnership together with any other business that partners are conducting in their own name. According to Article 2 of Ministerial Decision No. 127 of 2023 on unincorporated partnership, foreign partnership and family foundation, an unincorporated partnership is not considered to be a taxable person in its own right as long as it is not a juridical person. Partnership shares. It is open to the partners to set out how they will share the profits and losses, and the assets and liabilities, either through a written partnership agreement or verbally. Under Article 16 Clause 3 of the Corporate Tax Law, the distributive share, profit share ratio, of each partner is determined in the contract that formed the unincorporated partnership. However, if profit share ratio is unidentifiable, the authority will prescribe the manner in which the income or loss of the unincorporated partnership should be allocated for corporate tax purposes. Partnership appropriations. Article 16 Clause 5 of the Corporate Tax Law mentions that the interest paid by unincorporated partnership to partners on their capital contributions is treated as part of each recipient partner's share of taxable income. Partners' expenses. According to Article 16 Clause 4 of the Corporate Tax Law, where a partner has personally incurred expenditure in relation to the partnership business, this can be used to decrease the amount of partnership income on which that individual is taxed. This may include interest on any borrowing in respect of capital contributed to the partnership. Same rules apply for determining which expenses are allowable that we have already seen under Chapter 9 of the Corporate Tax Law, including the wholly and exclusively rule, disallowance of capital expenditure, and restrictions for non-business expenses and for business entertaining. Partnership allocation pro forma. An example of the allocation of a partner's parentship income can be found in the table below. Each partner's taxable partnership income is AED 35 and AED 33 respectively that the individual partner will declare to the FTA, after any necessary adjustments as per Article 20 Clause 2 of the Corporate Tax Law. Foreign partnerships. Corporate tax law defines foreign partnership as a relationship established by contract between two or more persons, such as a partnership or trust or any other similar association of persons, in accordance with laws of a foreign jurisdiction. Under Article 16 Clause 7 of the Corporate Tax Law and Article 4 of Ministerial Decision No. 127 of 2023 on unincorporated partnership, foreign partnership and family foundation, a foreign partnership is treated as an unincorporated partnership for corporate tax purposes if all the following conditions are met. It is considered as not taxable in its own right in the country or territory where it was formed. Each partner in the foreign partnership is individually subject to tax on their share of any income of the foreign partnership as and when the income is received by or accrued to the foreign partnership. A partner is considered to be subject to tax if they would be subject to tax on their distributive share of any income in the foreign partnership in the jurisdiction in which the partner is a tax resident. It submits an annual declaration to the FTA to confirm that it has met the above conditions. Adequate arrangements exist for cooperation between the UAE and the jurisdiction under whose applicable laws the foreign partnership was established, for the purpose of sharing tax information of the partners in the foreign partnership. Example of such arrangements are an agreement with the UAE on exchange of information on tax matters, the Multilateral Convention on Mutual Administrative Assistance in Tax Matters established by the OECD, or a double taxation agreement with the UAE including provisions related to exchange of information. If foreign partnership does not meet the above conditions, then it will be regarded as a fiscally opaque entity for corporate tax purposes and will be subject to UAE corporate tax on the same basis as a non-resident taxable person if it has a permanent establishment or nexus in the UAE. Application for the unincorporated partnership to be treated as a taxable person. The default tax treatment of unincorporated partnership income is as a fiscally transparent entity. According to Article 16 Clause 8, 9b and 9c of the Corporate Tax Law, the partners in an unincorporated partnership can apply to the FTA to request that the partnership itself be treated as a taxable person that is fiscally opaque for corporate tax purposes. Upon approval of this application, one partner must be appointed as the nominated partner responsible for obligations and proceedings who will be the contact person for correspondence with the FTA. Each partner in the unincorporated partnership will remain jointly and severally liable for the corporate tax payable by the unincorporated partnership for those tax periods when they are partners. Under Article 3 of Ministerial Decision No. 127 of 2023, where the partners in an unincorporated partnership apply to be treated as a taxable person, the application is irrevocable except in exceptional circumstances and with the approval of the FTA. The FTA must be notified by the unincorporated partnership within 20 business days of a new partner joining the unincorporated partnership, an existing partner leaving the unincorporated partnership. Family foundations. Investment income of natural person is not subject to corporate tax, therefore any structure including contractual trust, private trust company or a foundation used to hold and manage personal assets and investments should also not be subject to tax. For this reason, family foundation can apply to FTA to be treated as unincorporated partnership as per Article 17 Clause 1 of the Corporate Tax Law and hence not be subject to tax. Approval of the application by FTA would result in the beneficiaries of the family foundation being seen as directly owing or benefiting from the activities and assets of the family foundation for the purpose of corporate tax. Under Article 17 Clause 1 of the Corporate Tax Law and Article 5 of Ministerial Decision No. 127 of 2023, various conditions must be met in order to make the application. The family foundation must be established for the benefit of identified or identifiable natural persons, or for the benefit of a public benefit entity, or both. The principal activity of the family foundation must be to receive, hold, invest, disperse, or otherwise manage assets or funds associated with savings and investment. The family foundation must not conduct any activity that would constitute a business or business activity, had the activity been undertaken or its assets held directly by its founder, settler, or any of its beneficiaries. For example, if properties can be held solely under a license by a natural person, so income generated from such properties is taxable if held directly by natural person rather held by a family foundation. The family foundation must not have avoidance of corporate tax as its main or principal purpose. Where one or more of the beneficiaries are public benefit entities, the family foundation must meet one of the following conditions. Such beneficiaries do not derive income that would be deemed as taxable income in the event they had derived it in their own right, or the above stated income is distributed to the relevant beneficiaries within 6 months from the end of the relevant tax period. This ends our video session. Subscribe to our channel, and click on notification icon to stay tuned to the series of valuable material that will cover all aspects of the UAE corporate tax. Our partner is available for free consultation who is holder of FTA approved UAE corporate tax qualification. His contact details are provided here. Visit finexcel.ae. Navigate to our clients and testimonials webpage to see more clients' review on our services and our major clientele. Contact us for more detail. FinExcel. We create value that matters.